Hello everybody. In this session we are talking about liquidity. Liquidity describes the degree to which an asset can be quickly bought or sold in the market at a price reflecting its intrinsic value. Cash is universally considered the most liquid asset because it can most quickly and easily be converted into other assets. Tangible assets such as real estate, fine art, and collectibles are all relatively illiquid. Other financial assets, ranging from equities to partnerships units, fall at various places on the liquidity spectrum. For example, if a person wants a 1 million rupees refrigerator, cash is the asset that can most easily be used to obtain it. If that person has no cash but a rare book collection that has been appraised at 1 million rupees, they are unlikely to find someone willing to trade the refrigerator for their collection. Instead, they will have to sell the collection and use the cash to purchase the refrigerator. That may be fine if the person can wait for months or years to make the purchase, but it could present a problem if the person has only a few days. They may have to sell the books at a discount instead of waiting for a buyer who is willing to pay the full value. Rare books are an example of an illiquid asset. And then we move to the financial liquidity. Items on a company's balance sheet are typically listed from the least liquid. Therefore, cash is always listed at the top of the asset section, while other types of asset such as property, plant and equipment are listed last. In finance and accounting, the concept of a company's liquidity is its ability to meet its financial obligations. The most common measures of liquidity are the first, current ratio, current asset minus current liabilities. And then second, quick ratio, the ratio of only the most liquid assets like cash and then accounts receivable, etc., compared to current liabilities. And then the third, cash ratio, cash on hand relative to current liabilities. And then what liquidity means for the business. A ratio of 1.0 or more shows the business can cover its costs and is generally in good shape. A ratio of less than 1.0 is not so positive but isn't necessarily a bad thing. A business that's investing in growth will have bigger bills and may find their current ratio drops below 1.0. However, most businesses will want to avoid having a ratio that is permanently stuck at less than 1.0. The liquidity ratio will change depending on where a business is in its billing cycle. So, it's a good idea to measure it at the same time every month. That way, you're comparing like for like and can see if liquidity is trending up or down over the long term. And then, importance of liquidity. Liquidity is crucial in the financial world and for companies and individuals for several important reasons. The first reason is meeting short-term liabilities. Liquidity enables companies and individuals to pay their short-term debts and current expenses such as salaries, rent, utilities, and supplier bills on time. Without sufficient liquidity, financial bottlenecks and payment defaults can occur. And then the second, more favorable credit conditions. Companies with high liquidity can often negotiate more favorable credit terms as they are considered less risky. This reduces financial costs and improves profitability. And then the third, financial stability and confidence. Companies with high liquidity are considered more financially stable and less risky. Investors, lenders, and business partners prefer such companies as they are less susceptible to payment defaults. This strengthens confidence in the company and facilitates access to financing and better conditions. And then fourth, avoiding insolvency. A lack of a liquidity is a common cause of insolvency. Even profitable companies can get into difficulties if they are unable to service their short-term liabilities. Sufficient liquidity is therefore a protective mechanism against insolvency risk. And then fifth, crisis management. In times of economic uncertainty or unexpected events such as market crisis or natural disasters, liquidity is crucial. It enables companies to absorb financial shocks without jeopardizing their long-term goal and investment. And then the types of liquidity. There are three types of liquidity. The first type, asset liquidity. This means how easy it is to convert an asset into cash. The piece of land is an illiquid asset. The most liquid asset is cash because you can use the cash you have and buy anything from it in the market. Certain assets are highly liquid. For example, stocks which trade in high volumes tend to be highly liquid. And then the second, accounting liquidity. This means whether a company has assets which can be quickly converted into cash to pay its obligations, such as assets include cash, cash equivalents, marketable securities, debtors, and inventory. And then the third, market liquidity. Market liquidity means whether a market has enough scope for a high number of buyers and sellers to operate. For example, the stock market has millions of buyers and sellers, which means it has high liquidity. However, the market of rare paintings typically has only a few buyers and sellers. Hence, it has low liquidity. I think it is enough for this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe, and share. Thank you.